Equity markets are at an interesting time. Top-down macros are deteriorating, primarily driven by oil, and bottom-up micros are improving. The first concern for the market is higher oil prices. From a range of between $40 to $60, oil prices have moved to $70 to $80. Every $10 increase in oil prices widens India's current account deficit by about $8 billion. It adversely impacts GDP growth between 16 to 25 basis points. It increases inflation, fiscal deficit, and generally results into rupee depreciation. While OPEC and Russia has decided to increase oil production, the future trajectory of oil prices could still remain elevated. That could have implications for Indian market. The second concern for the market is higher real interest rates and credit squeeze. Some portion of Indian economy today is experiencing credit squeeze as 11 out of 21 PSU banks are under prompt corrective action, and rest of the PSU banks are also not extending credit as freely as before. The interest rates have remained elevated. We expect RBI to be data-driven. However, their April 6th Monetary Policy Committee minutes do indicate possibility of a rate hike for 6th June monetary policy. Gilt markets have factored in multiple rate hikes. It is evident from the spread of 186 basis points between 10-year government securities at 7.86% and repo rate at 6%. The shorter end of the curve has also factored in multiple rate hikes. It is evident in 160 basis point spread between 90-day CP at 760 and repo rate at 6%. Tight liquidity and high real interest rates, along with lack of ease of doing business, can act as a speed breaker on the economic growth going forward. Global factors like tariff war and US interest rates, which are hovering around 3%, could cause a transient impact. The nature of the government post-2019 general election will also start casting its shadow on the minds of investors over next 12 months. It's too early to predict election outcome. However, bipole results, combined opposition unity, state election results in December 18, these are few of the variables which market will use to predict 2019 general election outcome. What market wants is a reform-oriented government rather than an unstable government. If they get a stable government, markets will be fine post-2019 general election. So top-down 2018 is looking like a South African pitch where you have to bet very carefully. On that pitch, you have to play T20 like a test match. You have to face a lot of hostile deliveries to score run. Making money is not going to be easy in FY 2019, just like making runs were not easy on South African pitches. On the other hand, bottom-up things have started improving. Rural and urban consumption is doing well. With rupee depreciation, hopefully FY19 will see better exports growth and lesser Chinese dumping. This will help India growth story in FY19. And recovery in exports will be the positive effect of rupee depreciation. The government's investment is continuing well. The limiting factor for Indian economy is lower level of private investments. They are probably low because of credit squeeze, high real interest rates, and to some extent lack of ease of doing business. We could hopefully see recovery in private capex towards second half of FY19 post general elections. The fourth quarter GDP FY18 estimate came at 7.7%. It was well above expectations of the market. This indicates that finally the side effects of disruptive reforms like GST and demonetization is behind us. Some of the snippets in last few months give confidence that this economic momentum is building up. Bollywood movie collection has crossed rupees 1100 crore for the first time in Jan-March quarter. A Hollywood movie like Avengers Infinity Wars has crossed 200 crore box office collection. Domino's and McDonald's kind of listed fast food chains are showing 20% plus same-store sales growth in March 18 quarter. Tractor, passenger vehicles and commercial vehicle sales are at all-time high levels. GST collection for March 18 has crossed rupees 1 lakh. Even April number at about 94,000 crore is quite increase over the average of 85,000 crore previously. Most management whom we have met in last few months are becoming positive about future growth, though many of them are complaining about ease of doing business. The upside of market is kept because of higher oil prices, credit squeeze and high real interest rates, and also 2019 general election related uncertainty. The downside of market is also restricted because of improving corporate performance. Unless one of these factors changes, the trajectory of market will not change and it will be range bound. The underlying momentum of market is good with normal monsoon and benefits of existing reforms coming through. The GST should also result into organized sectors improving further. Weaker rupee will facilitate exports and restrict Chinese dumping. Rural, agriculture and infrastructure sector normally does well ahead of the election cycle as government spends more money in those sectors. There are certain mid-caps, small caps and micro caps which have been driven in the past by greed and momentum. These stock prices are now coming down to meet their fundamentals. We think there is still some room for them to go down. At the same time, there are many quality mid-cap stocks which offer good opportunity to invest for a long-term investor. These stocks have corrected, but they are making process of bottoming out. So at some point of time, mid-caps will become attractive to invest. The market is today supported by domestic fund flows. Sensex Nifty is trading at above historical average valuation on a P/E ratio basis, courtesy domestic flows. This year, flows will be balanced by the supply of papers as companies take advantage of higher valuation, and the government will look to do massive divestment to contain fiscal deficit. The supply of paper will be one more factor which will cap the market upside. While India looks expensive on a price to earning ratio above historical average, the market cap to GDP ratio at 84% is fair. The long-term growth story of India is intact. The valuation is neither cheap nor expensive. The market is fairly poised, supported by domestic flows. The returns of last calendar year 2017 are unlikely to be repeated in calendar year 2018. On top of it, the volatility of calendar year 2018 is likely to be far higher than calendar year 2017. In effect, 2018 will be like South African pitch which will favor bowlers. Making runs will be difficult. But if you apply yourself and play T20 like a test match, you will get loose balls which you will be able to hit for scoring run. A disciplined asset allocation and longer term investment horizon will be the best way to benefit from the market volatility. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.